All right. Thank you so much for joining us, everybody. My name is Lisa Partida with Home Again LA. So tonight we have the makeup session for the first-time homebuyer series, and we are going to be covering assessing home ownership and then also briefly covering the loan and purchase agreement. So I'll go ahead and pass it along to Isabel with Operation Hope, who is going to be the presenter for tonight.
Okay, thank you very much. Let me just go back to the PowerPoint and let me put it on slideshow. Okay, and then share my screen. Okay, so can you see this screen?
Yes.
Okay, great.
Yes.
So this particular workshop of homebuyer education is following the HUD homebuyer education program. So we use their information, we use their slides in order to explain to you all the steps that a family will take, or a couple will take, or a person will take when they're ready to buy a home. And it's basically just giving you information of what's going to happen step by step. That way, you will be ready whenever you choose to purchase a home. You will know all the steps. You'll remember, because it's a lot of information, and sometimes we forget. But the information comes back to you when you're talking to a lender, when you're talking to a real estate agent, when you're talking to another officer, and we'll explain some of the people involved that will help you become successfully a home buyer. So I'm going to start with, we need to talk about assessing home ownership, which is really a series of questions and information to have you start thinking about buying a home, to see how we can help you get ready for that. But you have to really mentally want to buy a house. You want to understand that you are ready for it mentally wise, okay, that you really want to. And we'll give you information for that. Then we're going to go into part 2, which is credit and debt. This is to prepare yourself to improve your credit report in order to be able to apply to the mortgage company or the bank or the financial organization that you may go to. So you will be ready to apply for a mortgage. And first of all, we'll talk about the approval letter, where you will ask the lender or the mortgage or the bank to see if you will be able to apply, and then how much of a house you can buy. So we're going to talk about that too. All right. And so many other things. So one of the first question we're going to start is home ownership for me. Buying a home is a major part of the American dream. However, it is important to note that home ownership is not always the best choice at any given time. By participating in home ownership, by participating in home ownership education and counseling, each participant leaves better prepared to determine the best route for their personal journey in the home buying process. Planning. So once you're ready, you will be planning, what can I do? So first of all, we want to emphasize long-term affordability. It is critical to purchase a home that you can afford in the long run. It is important to make sure your monthly budget allows for home payment plus a cushion to cover maintenance and repairs. So we'll talk about house hunting, a checklist, obtaining financing, learn how to compare loans, negotiate and enter into contract, loan approval, and closing. So this is my favorite slide because it talks about choosing a competent team to facilitate the home buying process. So when I first started doing the workshops, I realized that a lot of people were asking questions. Okay, so where do I start? Who do I go to? I don't know any real estate agents. I don't know any lenders. And there was all this information that nobody was ready for. And with this slide, we talk about the people that will be involved with your home buying process, and we call it a team. And I always talk about how the city of Los Angeles is just a sports galore area, city and areas. I mean, how many stadiums do we have now? How many teams? And everybody has a captain and has a, star team. So I want you to think as you are the star and you're going to choose a team that will help you. Some of the team members can be a realtor, a real estate agent. We're going to talk about that too. Lenders, inspectors, HUD counselors. I'm a HUD counselor. You don't have to choose me, but I am what a HUD counselor looks like and talks like. But you can always get another HUD counselor. We have quite a few at Operation Hope. We also need a good insurance agent who will explain what is it that they're going to cover when you're ready to buy a home, so they can cover it with the insurance. And then there's the escrow company who comes in and makes sure that the seller and the buyer is submitting paperwork correctly, everything's signed correctly, everything's legal. And there's quite a few other team members that we're going to talk as we go further on in the workshops. So you are now the captain of your team. So let's talk about the difference between renting and owning. First of all, renting, the good stuff is that it's flexible. When you rent a small apartment, it's easy to pack a box and move to another apartment. But if you have a house, you can't pack the house in a box. It's very hard to be flexible with a house. But with renting, you have some flexibility. There's also low cost of entry. So it's really first and last month's rent. That's a little bit of a low cost. There's no property taxes, no maintenance costs. If something breaks in the apartment, all you have to do is call the landlord and say, hey, I have a leak in my sink, help me. And they come in, fix it, and there's no cost to you. Also, low cost insurance and amenities. Amenities are special amenities, special things that are in the apartment complex. There's some complexes that have 2 or 3 buildings, and in between them, there may be a pool, there may be a patio, there may be a little park for the children, or a laundromat. So those are amenities. But most of the apartments I see over here in Los Angeles are straight up and very little room for amenities. There's room for parking, but amenities very short. Okay, so that's renting against owning. But the negative part about renting is that you don't develop equity. So equity is value. So something that you have that is a value monetarily. So when you make a payment for the rent, you pay the landlord or you pay the owner, and that landlord uses that money to pay the mortgage on the apartment building. And as they start paying down the mortgage, they start earning value because the more you pay on your mortgage, the lower the debt of the mortgage goes away, and what you have left is the value of the property. So with renting, you don't get that because you're giving the money to the landlord or the landlord or the owner. You also don't have control over the property. So if you go to one of these apartment buildings where they tell you, we don't allow plants, we don't allow animals, we don't allow you to paint anything, we don't want any kind of visitors. You know, I've seen those kind of properties. And then there's rent increases. So unfortunately, I see this every year in the apartments industry. Lease termination. Sometimes the landlord wants to have the other side of the family move in your apartment. So they're gonna give you a paper saying we're asking you to move in a week because my family's coming in, and there's nothing you can do. There's also high monthly costs. Sometimes moving into a nice apartment, you realize that now you have to call the telephone company to connect your cable and everything else, and it turns out to be a little costly. Okay, so owning versus renting. What's the positive owning? You build equity. When you buy a house and you start making your monthly payments, every time you pay your monthly payments, the debt goes down and your value goes up. And that's what we call equity value. You're also forced to save. You always have to put some money aside to make sure you pay your mortgage payment on time. If you don't pay your mortgage payment on time, they're going to charge you $50 for being late. Tax benefits. So when you do your end of the year tax returns report, you can write off the interest on the mortgage that they're charging and also on the property tax that you have to pay along with the mortgage. You can write that off, and that gives you a reimbursement. So it's kind of helping you save yearly. Complete control over property. Once you're buying your house, that is all yours, including the land. So you have complete control over the property. Now you can paint it what you want. You can bring in plants and animals. And there's potential future income. So as you stay in your property for 30 years to, pay off the mortgage, there's so many opportunities and options you can look into in order to create another income using your home, maybe creating another unit or remodeling your garage into another unit and start renting it out. So there's a lot of potential there. Okay. Now, assessing your situation, loan readiness, questions to consider. Do I have a steady source of income? Have I been employed on a regular basis for 2 to 3 years? Is my income reliable? Do I have a credit history? Do I have a good record of paying bills? Am I able to pay my bills and other debts? Do I have money saved for a down payment? Things to think about. You don't have to answer me, but you can just think about that. And I think there's a question. No questions? Okay. All right. So if you answered yes to these questions, you might be ready to buy a home. If you answer no to any of them, concentrate on strengthening those areas. Okay. Consider where you are now. What are your needs versus wants? Is there an urgency to move? Have you been given that lease termination? What is your confidence about your income? How much have you saved? Your credit rating. What's your credit rating? Because that's one of the things that the lender will ask in order to find out how much of a house you can buy. Okay. So now we have to really think about what is it that we really want and what is it that we really need. And we need to divide the needs versus wants. We would love to have another sofa or another TV because it's kind of breaking down, but we really need a new home. So we now have to start thinking differently. We need to really work on our needs. And then the fixed expenses, we got to continue looking at the fixed expenses because that's could be something like your registration to your car or your insurance. And so those are the kind of things that you need to always take care of yearly. Periodic expenses, okay? Again, it always has to do with the car or with medical expenses. Looking at visiting the doctor, making sure you're okay. Burial expenses sometimes come as a surprise, like when you have to fix your car. And I'm just talking about a tune-up, maybe changing tires, little things like that. And you should track your expenses. Have flexibility and limit credit card usage. So if you're really thinking about buying a home, you really need to start saving money. So limit that usage of card, and you only buy with your credit card what you really need. Okay. All right. So once you are finally financially ready to purchase a home, it is important to locate one that meets your needs and wants. Therefore, you must conduct research to discover area of interest, schools, access to shopping, and public transportation. Yeah, take a look at your computer and go to websites that are mentioning homes in different locations and just see what they write about the homes. What's the prices, what kind of neighborhood is it? And that will give you an idea as you start thinking about buying a home, if you're ready for that. So be realistic, be flexible, be responsible on all the search. It's good to know, have more information, and you can ask anybody. You can call a real estate agent and say, hey, what kind of houses are there available? And they can, give you a good amount of information from their resources. Okay. So, so far, any questions? Okay. I'm gonna get into no questions. Okay.
No questions for now.
Okay. All right. Understanding credit and debit. I think a lot of you have already gone through the credit workshop, but it's credit and debt is something that's pretty important to talk about when we're thinking about buying a house, because we have to understand that we need to have a good credit history and we have to have a very low debt in order to be able to buy a home. So what is a clean report? A credit report, I'm sorry, what is a credit report? A credit report is a summary of your history of repayments to your creditors. In other words, banks, department stores, credit unions. The credit report has 4 sections. It starts with personal information like your name, your social security number, your date of birth, and then your addresses. And then there's public records, credit accounts, and credit inquiries. It is a record of your credit activities that includes credit card accounts, loans, balances, how regularly you make payments. It also shows if any action has been taken against you because of unpaid bills, like collection items or public records. So I am able to pull the TransUnion credit report as a soft pull if you're interested in knowing what is going on with your credit report, so you can understand what's being reported, okay, at no cost. What is a credit report? I'm sorry, a credit score? A rating with a credit report of the credit cards you've used and how you used it, it comes with a score. It's a rating that's drawn from your credit report, which outlines your borrowing, charging, and repayment activities. Good rating can help you pursue financial goals. A poor rating limits your financial opportunities. The score is called FICO score. It ranges from 300 to 850 points, and the medium score is about 715. And one of my other assignments with Operation Hope is to help people get to the 715. But we start from the beginning. We start looking at the credit reports and we see what's being reported, what can be fixed. We start making work plans and work, little by little, so we don't upset the budget of the client. And it works. So the score has different parts. And here in this pie chart, the most important part is the payment history. Of all the items in the history and in the report of your credit, the most important part is having a good history of paying on time. So everything is now done electronically. So when you use your credit card and you buy something, that goes electronically to the creditor, whoever you borrow money from. And then when the bill comes in, usually a week or two later, it tells you how much you bought, how much the payment will be, and the date of the payment. You really have to pay attention to that because the most important part is paying on time. So if they tell you you have to pay on the 15th of the month, you have to pay on the 14th to make sure it's registered on the 15th. And that will really give you a good credit score, paying on time every time, as long as you keep paying down whatever you borrowed. So you also need to understand the credit card. With a credit card, they mail it to you as opposed to giving it to you at the bank. They actually take 2 weeks to mail it to you, and it comes with a letter saying you have a credit limit. So instead of saying, oh, you were approved for $1,000 and the interest is 6%, the payment's 150, and you got to pay on the 15th, the credit card gets a little letter saying you have a $1,000 credit limit. So that means you can use the card to buy what you need, and then when the bill comes in, you make the payment. But the strategy is not to use the whole $1,000, because if you use the whole $1,000 they gave you, then you don't have any money left over. And so the question is, how would you make the payments? And that's why FICO comes in and takes points off your score, because you used up all your credit limit. Now you have no more money. So the strategy is to use 50% of your credit limit. So if they gave you $1,000 credit limit, use only $500. Buy what you need. When the bill comes in, make a good payment, and maybe the second week pay down the balance. That way your points will start going up that way. Honestly, that's the trick. So with a credit card, pay 50%, keep the balances lower. Try not to use over the credit limit. I know sometimes people, all of a sudden they need a washer, and it's like $500 washer, and it's beyond what they gave you. So be careful, that you only use less than $1,000, because if you buy something more than $1,000, the bank may close your account because you went over the credit limit. And the question is, where did you get that money? So you will need to start paying down that balance to get that off your credit report. Okay, so how long you've had credit history gives you points. Having a mixture of a loan and a credit card gives you points. And here's the only thing that's not positive. It's how long it's getting new credit. Every time you apply for a new credit card, it shows up on your credit report as an inquiry. And every time they look at your credit report to give you credit, it's called a hard pull. So they will take off 2 to 4 points off your score. So be careful about applying for credit cards. You really don't need 10 credit cards. You need 3 credit cards to get along with. But you have all the right to apply for a credit card that may benefit you. But just know that they're going to look at your credit report and they'll take 2 to 4 points off your score. So if you're ready to buy a house, you don't want your score to change once you apply with the lender and try to get how much of a house you can buy. Because if you change the credit number, it just relates to the amount of time it will take to get you applied. I'm sorry, yeah, approved, I meant. Okay, any questions? So we have some terms and definitions. So a borrower is, oh gosh, hold on. A borrower is the term of the person or entity which is using someone else's money or funds to purchase something. The term borrower can generally be used interchangeably with the term debtor. Annual fee. An annual fee is a once-a-year charge imposed by many credit card issuers. So when you're applying for a card, find out if they're going to have a once-a-year fee that you have to pay. APR is annual percentage rate. This is the cost of credit expressed at a yearly rate, which includes the interest and certain fees that a borrower is required to pay for a loan. And then assets is everything of value an individual or entity owns, such as a car. If you've paid off your car, you have an asset as a car. Balance, the amount of money you have in your bank account. It can also refer to the amount owed in a credit account or loan. Creditworthiness is a term used to describe the state of or the condition of an individual's credit, overall credit. An interest rate. Interest rates are commonly thought of as a cost of borrowing money. Judgments are formal orders, generally court orders, which are displayed on a credit report if a debt or loan obligation is unpaid. If in the future you find yourself unable to make certain items, it may go to collection, and the collection agency may summons you to the court. If you get a court summons, please show up. You have more chance to talk to the judge to get a payment arrangement than not going and having to pay the fees of the judgment. Okay. Credit risk. Credit risk is the term within the credit industry to refer to the level of risk or likelihood of an individual, borrower's future or potential default. Okay. So it means that you look good if you have good credit history. All right. Okay, how do we improve credit? It's important that you review them carefully to be sure they are correct. So again, I can get you a credit report. If there's any mistakes, we can ask and write a letter, dispute letter to the credit bureaus to correct it. We need to look for late payments, judgments against you, tax liens, child support. If not corrected, negative items can stay on your record for 7 years or more, unfairly lowering your credit score. Okay. All right. So any questions? So Lisa, should I get into the loan application? Hello? Okay, I'm going to get into the loan application, and we're going to talk about the process that people go through when they're applying for a loan. Okay, so I'll go fast. Topics to be covered. What is a mortgage? Oops, hold on. What is a mortgage? What are the steps involved in obtaining a mortgage loan? Getting approved for a loan? How much is the lender willing to lend? How do you know if you are ready to buy? Calculating qualification, and how do you increase your borrowing power? Okay, so this is the loan approval process, because a lot of people complain that it takes so long to get approval. And one of the reasons is that there's a lot of paperwork to fill out. When you're ready to apply for a loan, you have to, produce your tax returns, your bank statements, any kind of statements that shows different kind of income, like your savings, your CDs, your IRAs, if you get into other forms of money making and money saving, along with your employment. And I'm trying to think what else besides the tax returns and bank statements and employment information. So there's paperwork to fill out. And so what the lender does with you is make sure that all the paperwork that they're requesting is submitted. They look at it to make sure everything's filled out correctly. And then they turn it over to a pre-approval and see how much of a house you can buy. And at this point, they do pull your credit report to see what the score is, and then how much of an income you make. And then they give you a letter, a pre-approval letter saying, based on this quick examination of your paperwork and your credit, you can afford to buy, a certain amount of a house. And it's a 90-day that's good for the pre-approval. And this pre-approval letter helps the real estate agent find you a house within that range of income that you can afford. Meantime, the loan application that you filled out goes to a person who starts looking at and analyzing everything that's in the information. And if something comes out that is a question, so let's say in your tax return of 2 years ago, you stated that you got a bonus 2 years ago because business was good. And so they're going to ask you for information on that bonus. Is that bonus going to be every year or every 2 years? And they're going to ask you those kind of questions so you can start looking for the information. And then once they review everything and get the questions answered, it goes to underwriting. And then that's another section where they analyze the information and they analyze, how well this is going to turn into a loan that they will be able to fund. But they go through a lot of review and information, and they may actually call your employer to see if you work there. So meantime, you're looking for a house, and the real estate agent finds a house that you like, and you tell the lender, we found a house, we like to start, proceeding with a loan. And let's say during the appraisal, so there's a home inspector and appraiser who comes to the house that you like. One, the appraiser is to check and see and take measurements and find a comparison of the same size house, the same look of a house within a 6-mile radius, to see what has been sold within that radius. And that's how they put a value on the house. So if people are buying the houses that you like in the area for, 500,000, 600,000, that would be the price, the value of the house in that area. If the inspector finds plumbing that needs to be fixed, then everything stops, because now we have to talk about, well, there's plumbing to fix. Will the seller want to fix the house, the plumbing, so you could buy the house? Or will the seller give you a discount so you can fix the plumbing? So there's going to be some arbitration there, a little talk, and then finally, after a few weeks, you come to an agreement. Let's say the seller says, okay, I'll fix the plumbing. And then you go back to the lender and says, okay, the lender's going to fix the plumbing. And then the process of loan processing continues again. So some of those could be some times that the processing slows down because now we have to fix something. So then the loan processing goes on. The home inspector comes back and reviews what was fixed, and if it's fixed perfectly, then the report is finished. It's shared with you and the bank that the condition of the house is in good condition, the plumbing is fixed, everything's great. So then we get to the point where the lender's saying, well, okay, everything's good, the value is good, and I think we're going to approve it. So then they approve you, and then we start talking about the closing part of the loan approval. And then by the end, they're going to send you documents with a notary. So you could sign the loan documents and also put your fingerprints on the book of the notary. It goes back to the lender to make sure that everything's signed correctly. Then it's registered with the county register. Once it's registered, then they give you the keys to move in. So that's where you see the open door. Okay, it just seems easy, but it just takes a little longer than that. So pre-qualification, based on what you tell us how much you make, we can do some calculation and tell you more or less of a house you can afford. But a pre-approval is a little more of a firm commitment because we actually look more at your documentation of your income. We look at your credit report, and we look at your bank statements to see how much of a deposit you have. And then we can say you have a pre-approval. This is good for 90 days, so you could find a house. Okay, and so during the whole loan process and looking at everything, the lender will look at your credit, capacity, capital, and collateral, which means that they want to make sure that if you have, do you pay your bills regularly on time? Do you have any collections or public records? What's your current debt? Do you have installment accounts, revolving accounts, other monthly payments? We really want to lower the amount of debt that you have in order for you to have a better choice of what kind of a house you can afford. Because the debt does make a difference of how much of a house you can afford. So they're going to check on everything. Also, the capacity means, what is your current income, income history, and future earning potential and amount owed. So we want to see that you have a good credit history. We want to see that you have the ability to earn enough money to pay the mortgage. Also, capital. What down payments have you started saving? Do you have loan fees? Do you have enough money for closing costs, escrow impounds and reserves, and moving expenses? So, as we were talking in the beginning about getting ready, one of the things is to save money because there are different expenses that come across. And collateral. In other words, what guarantees do you have? Well, basically, the house that you're going to be buying will be the guarantee of the loan. So is the value of the home worth what you are paying for it and the condition of the home? So we take a look at that very carefully. Also determining qualification, credit scores, loan to value, income, debt ratios, and employment. It's a lot of calculation here, okay? So debt to income ratio. So what we look at is we look at your gross income. So you tell us how much do you earn in a month. So let's say you get paid weekly. So we do the calculation of how much you make per week. And this is how much you get without taking the taxes out. We look at your payment before taking out the taxes. So for a month, let's say that you get paid, $3,000. And so based on that, we multiplied by 45%, and that should be your mortgage payment. Of course, it would be better if you make, instead of 4,000, if you make 6,000 a month, and we multiply by 45%, let me tell you what it comes out to. 6,000 times 45%, your payment would be $2,700. Okay. And then we look at what you make, and then we ask, how much debt do you have? Do you have a car payment that you're paying $400 a month? Or do you have a loan that you're paying $300 a month? So then we look at your $6,000 monthly income, and we subtract the $400 car payment. Oops, hold on. 6,000 minus 400 is 5,600 times 45%. Then your mortgage payment would be $2,520. And that has to concur with the amount of the house you can buy. So those are some things we look at. So it's very interesting. And it's just something that you have to understand how they calculate. Okay. And they look at your employment. They want to make sure that you have secured employment, and your income history. How long have you been working? We're looking at least 2 years in the same field. And most programs require proof of income, such as paycheck stubs and tax returns. If you're self-employed, you just need to show us your profit and loss statements for the last 2 and 3 years. Loan to value ratio. We want the loan to be at least 80% of the loan value. So, we look at the price of the house and we look at the loan. And if you can have that ratio where it's 80% of the value, then it's doable. Okay. So sometimes you don't find a house that high or that low, or maybe you do find a house low and it's too low for this particular qualification. Credit scores. It's very important to have a really good credit report, and the score has to be above 700 at least. 680 is the minimum. And here it says minimum score 580. 580 is the FHA loan score. That means the FHA are government secured loans. However, the banks that have those loans do not accept 580. They will accept 620 as the lowest amount of scoring. And along with the FHA loan, there is an additional fee for mortgage insurance. In case something happens and you can't make a payment, the insurance will pay for the mortgage. The score from FICO is 300 points to 850. Anything over 680 is doable to request a loan. So how much mortgage can you afford? Well, let's look at your grossly monthly income. So let's go back to maybe 6,000, and you multiply it by 45%, 2,700. That's going to be your payment, PITI payment. PITI stands for your, now I'm forgetting what the P stands for. The insurance, the taxes, the property, the P is the property taxes. And so it's insurance, taxes, property taxes.
It says, I'm sorry for interrupting. It says PITI stands for, goodness, I lost it. Principal, interest, taxes, and insurance.
There you go. Thank you.
You're
all these letters. Yeah, so think about that kind of a payment every month. And if you could do it, great. That's great. Okay. All right. Choosing a lender. Well, you know, there's quite a few lenders. There's banks, there's finance companies, there's credit unions. And sometimes, you know, going with a referral, maybe you had a relative or a friend who said they had a great time, they loved their lender, they can refer them to you. Also, lending institutions, again, those are banks, finance companies, mortgage companies, and credit unions are pretty good. If you belong to a credit union, I think you have a really good deal there. Lender versus broker. So a broker for mortgages are independent agents who are good at putting together a mortgage package. And what they do is they look around the country of the United States and they present the package that they're working with to see if they would give them a good loan, a good process. And so if they do, because sometimes it's a customer with low income, I'm sorry, low score. So sometimes they're looking for lenders who are willing to lend money to low scores. The only thing that we have to advise you is that with the broker, there will be a commission you'll have to pay to the broker, as opposed to a regular lender. The bank will charge you a fee for the loan processing, but not to pay the lender. Credit union, you know, they'll charge you for the processing of the loan, but not to pay the person. So it's a little different when you have an agent helping you find a loan. Or you can look at the HUD website and look up the lenders that are HUD approved. Okay. All right. So documents that you will need to prepare once you're ready to go through this process: pay stubs, 3 most recent, Social Security, if you are receiving some form of income from Social Security, disability awards letters, Social Security card and picture ID, source of down payment, like a gift letter, tax returns at least 2 years, W-2 forms or 1099 for 2 years, bank statements, 2 or 3 most recent months, last final statements of others like your 403B, IRA, CD, etc. So if you do an outside savings, you just locate those documents to show that you have other reserves. Okay, so the source of down payment, savings can be your down payment, retirement account, gifts, down payment assistance programs, or the seller can help a little bit with the down payment, which will help you lower the price of the house. Okay, so what is a mortgage? It's a loan to finance the purchase of real estate, which is used as collateral for loan. And mortgages are structured by such factors as length, established payment periods, and interest rates. And pity, here we go. What does my mortgage payment include? Thank you. Principal, interest, taxes, and insurance. I forgot about interest. Principal, the amount of money you borrow. Interest, the cost of borrowing money. Taxes paid to local governments. Insurance, homeowners and hazards coverage. Okay, and the fixed rate mortgage is the typical mortgage that most people get. They want to get a fixed rate that never changes for 20 years or 30 years or 15 years. There used to be adjustable rate mortgages. That's been, I don't want to say removed. I'm just saying they're not normally offered ever since, excuse me, ever since this the recession. We had a lot of trouble with adjustable rate mortgages during the recession in 2008. A lot of people were forgetting that the adjustable rate changes And after a while, they can't make the payment. Excuse me. And then sometimes there's interest-only mortgages, which again may be a little hard because after that, they have to pay the principal, not just the interest. And then there's the option of adjustable rate mortgages. Excuse me. Sometimes some people buy a house and they know they're going to move in 7 to 10 years. They want to buy the house here and they know that they're going to have to sell it in 10 years because let's say they came to Los Angeles because they wanted to come to the college here. So they want to buy the house. They don't want to rent an apartment. And so they ask for an adjustable rate mortgage where it's going to change in 10 years. They just want the adjustable rate low so they can afford it. And then they sell the house and then everything's paid off. I don't see it too much. Not a lot of people are doing that, but it is available. Okay. But the best thing is the fixed rate mortgage because that way your payment will be the same for if you choose 15 years, 20 years, or 30 years to pay off the mortgage, it will be the same rate. The only thing that may change in those years is if your insurance increases on the fees for some reason. Let's say we're having a heat wave, we may have more fires than usual. So the insurance is increasing my insurance because we don't know if I'm going to have my house burned. But things like that happen. The insurance will change. Property taxes may change, but the interest stays the same, and that's more important right now. Okay. And then we have government loans. Remember FHA, where they can take credit scores as low as 620, is the FHA, Federal Housing Administration, provides mortgages insurance on loan made by FHA approved lenders. So they have regular mortgage loans. There's a 203K that includes property improvement. So you may be getting a house that needs a little fixture. So part of the amount of money that you need to fix a house can be included in the loan. And it's a 203K that's offered by FHA. Then there's the energy efficient mortgage. And of course, it's a brand new house, new kinds of appliances that are energy efficient. So that's not a lot here. I don't see it a lot here, but I hear about it. Then there's the VA, which is the Veterans Administration. They offer loans without deposits if you've been a veteran of the Army. And CalVet, so that's the name of the loan for the veterans. Conventional loans are the loans that the banks have. They're not FHA loans. They're conventional loans that the banks have, and they have Fannie Mae and the others that are the persons who back up the money. Then there's CalHFA, California. That's a California housing authorization. They have loans that recently have been helping with down payment assistance. And then there's, hold on a second, see if I can change this. Then there's the USDA Rural Housing Organization. They offer low income loans for people who live in rural housing that are a certain percentage of like farmland. The only thing I can think of closest that can describe that is Coachella. I don't know if you've heard of Coachella. It's turned into a concert galore, but before it was just nothing. It was just land, and cows would walk through, horses would walk through, and if you bought a house there, it was available through the USDA. They offer loans to low-income folks there. So I don't think they have cows anymore because they have a lot of concerts that I hear about. Right, any questions? 15-year mortgage, lower rates, builds equity faster, less interest to pay, large monthly payments. And then the 30-year mortgage is a higher rates, builds equity slower, can deduct more interest from income taxes and large monthly payments. So you have some choices, depending on how much you can pay. So a fixed rate mortgage, it's easy to understand, consistent payment amounts, easy to budget. Adjustable rate mortgage, you don't want to bother that, okay? Also points. So if you're able to save for a deposit, you may use part of your deposit to pay a point in order to lower the interest rate. So it depends on how much of a point you need to buy in order to lower the interest rate. But it's worth a try. Maybe a point can be, $1,500 that will lower 5% down to 4.5%, something like that. That could help you in the long run. Okay, so this covers a lot, all the way up to getting a loan. And now the next part is shopping for a home. And we'll be scheduling that maybe in a couple of weeks. Depends on my partner here, Lisa. Any questions?
No questions in the chat, unless anybody else has any questions. I'll go ahead and stop the recording.